Silver inventories are disappearing faster than most people realize, and yet the price on your screen keeps falling. That contradiction is not just confusing, it's deeply uncomfortable. Because we're taught a simple rule from day one: when something becomes scarce, the price should go up. But silver is breaking that rule right in front of us. And if you're holding silver, or even just watching this market, that disconnect can make you feel like nothing makes sense anymore. By the end of this video, you're going to understand why silver can physically disappear while the price still falls, how the paper pricing system overrides scarcity in the short term, and what signals you need to watch to know when this contradiction finally resolves. This isn't about hype or fear. It's about understanding how silver actually trades, not how we wish it did. To understand what's happening now, we need to step back and look at the timeline. The price didn't start falling because silver suddenly became abundant. In fact, the opposite was happening. Vault inventories were being drawn down, physical demand remained strong in key regions, and industrial usage didn't collapse overnight. What moved first wasn't supply, it was positioning. Liquidity tightened across markets, the dollar strengthened, and leveraged positions began to wobble. Price responded to that pressure long before physical scarcity had any chance to assert itself. This is the first hard truth about silver. The paper market sets the narrative long before the physical market gets a vote. Think of the paper price like a shadow cast on the wall. The shadow can move independently of the object creating it, at least for a while. Futures contracts, options, and ETFs dominate price discovery. They trade enormous volumes of silver that never physically change hands. When sentiment shifts or leverage breaks, that shadow moves violently, even if the real object, physical silver, hasn't changed at all. The second reason scarcity doesn't immediately support price is leverage. Silver is one of the most leveraged major commodities in the world. That leverage acts like a storm hitting a small boat. It doesn't matter how valuable the cargo is if the waves are high enough. When silver prices start falling, margin calls trigger automatically. Forced selling overwhelms natural buying. Industrial users don't rush in to catch falling knives. They wait. Investors with physical demand don't set bids aggressively during chaos. Leverage drowns scarcity in the short term. The third reason is that silver demand is fragmented. Industrial demand, investment demand, and retail physical demand don't move as a single force. They leak in different directions at different times. Imagine trying to fill a bucket with holes in it. Water keeps pouring in, but it never fills fast enough to counter what's leaking out. Industrial users buy on contracts and timelines. Retail buyers respond emotionally. Institutional players trade paper exposure. That lack of coordination means real demand can exist and still fail to support price in the moment. Now let's look at the data that proves this contradiction is real, not imagined. COMEX and LBMA inventories have shown consistent drawdowns over time. Physical silver has been leaving vaults. At the same time, open interest in futures markets has fluctuated sharply, often declining during price drops. That tells us positions are being closed, not accumulated. Physical premiums in many regions have remained firm or even risen, while futures prices fell. That divergence is critical. It shows that paper selling, not physical abundance, is driving price action. Historically, this divergence appears before major turning points. When physical silver disappears while paper prices fall, it usually signals stress inside the pricing system. The market is saying two different things at once. One voice says silver is needed, the other says leverage must be reduced. In the short term, leverage always wins. In the long term, scarcity always matters. The only question is timing. We've seen this before. In past cycles, silver inventories tightened even as prices declined. During those periods, frustration dominated sentiment. Investors questioned the entire thesis. Many gave up before the resolution arrived. Then, when leverage was finally cleared and confidence shifted, price repriced violently. Not gradually. Suddenly. The market doesn't reward patience with comfort, it rewards it with surprise. There was also a moment in history when paper pricing lost credibility entirely. Physical demand overwhelmed the system and price discovery shifted away from futures markets. That didn't happen because people believed harder. It happened because the structure could no longer absorb the stress. Until that point, scarcity and falling prices coexisted uncomfortably. So where does that leave us now? There are only a few realistic paths forward. One possibility is that price continues falling or stagnating despite physical drawdowns. This scenario persists as long as leverage remains and liquidity stays tight. It ends only when forced selling is fully exhausted. Another possibility is long, grinding sideways action. Price frustrates everyone. Believers lose patience. Skeptics lose interest. This phase ends when participation collapses. The third scenario is a sudden repricing. The contradiction snaps. Physical demand overwhelms paper selling, and price moves violently higher in a short window. This scenario is invalidated only if paper markets regain full credibility. What should you do while this contradiction exists? Stop watching price alone. Watch open interest. Watch margin changes. Watch inventory drawdowns relative to price. Watch physical premiums. These signals matter more than headlines. Understand whether you own silver as a long-term asset or you're trading it as a short-term instrument. Physical silver doesn't care about daily volatility. Paper exposure does. Most importantly, understand that falling prices do not automatically mean disappearing demand is irrelevant. They mean the system is under stress, and stress systems behave in ways that feel irrational until they break or reset. Right now, there are three types of people watching this. The first is confused, bouncing between headlines and charts, trying to reconcile scarcity with falling prices. The second is frustrated, convinced the market is broken and ready to give up. The third is observing structurally, understanding that contradictions like this are not permanent, they are transitional. Only one of these groups consistently survives markets like silver. So ask yourself honestly, if silver is disappearing but the price is falling, does that mean the story is wrong, or does it mean the timing is wrong? Drop your thoughts in the comments. If this breakdown helped you understand what's really happening beneath the surface, share it with someone who's struggling to make sense of this market. And if you want clarity instead of noise as this story unfolds, stay connected. Because in silver markets, contradictions don't last forever. They resolve suddenly and usually when the most people have stopped watching.